I think we are approaching a critical time in the stock market where we have many different indicators. Some of them are actually pointing out that the recession is here. Some indicators are pointing out that we are pretty close to something major actually breaking. And some indicators are potentially pointing out that maybe the stock market could have potentially bottomed. I'm going to talk about all those three indicators today and share them with you guys in this video. And it's getting pretty confusing to actually know for certain where the stock market is going next and what's going to really happen with the economy. And I'm going to talk all about that today. But let me start with the first indicator that's actually telling us a lot of things that a lot of people are not listening to. And this is crude oil. And crude oil have started to go down. And crude oil is notorious for going down into a recession. And whenever crude oil is going down that much, we could look at what happened in 2008. It went down a lot. It peaked around, I believe, $140 a barrel, and it crashed. And as oil was going down, and now it's going down, it's telling us that the recession is getting deeper, that the supply and demand doesn't matter. This is what I was trying to argue with people that are bullish on oil. On my last video and on Twitter, I told them I get the supply and demand, but recession fears alone can crash the price of oil. And the supply demand stuff doesn't matter whenever you have people thinking from their emotions and from their own decision. And what the market is telling us with oil is that the recession is getting deeper. And we are entering pretty much, the deepest part of the recession. And we're going to find out how it's going to look like over the next 3 to 6 months. But crude oil is a key indicator here. But it's not only crude oil. It's whenever crude oil is actually going down and gold is actually going up. This is it's a pretty important indicator of the crude oil to gold ratio. And whenever this ratio is doing that, whenever you're having, crude oil going down and then you have gold going up, it's actually telling you that investors are somewhat fearful, that there's a lot of recession fears, a lot of risk, and investors are, not bullish on the economy in the short term, and they are more, bullish on assets that are safe havens like gold. And the gold miners, GDX is going up. I have a junior gold miner I've been holding for over a year. Now it's up over 62%, not including dividends. I mean, these stocks are going crazy. And gold is a key indicator here, and it's telling us that investors are fearful and they are going to safety. And this could tell us that something bad is brewing. Something bad could potentially happen in the future. And one of the most notorious indicators that's telling us that something bad could happen in the future, and I have been talking about this many, many times, is the yield curve, which is the 10-year minus the 2-year. And now it's starting to reinvert and is heading to positive territory. As you can see what happened in 2008. 2008 happened after we went back positive. Same thing in the 2000s, same things in the 1980s. And now we reinverted and we're starting to head back to positive. So once the yield curve actually flips positive, this is when we should be worried. This is when we should be, very cautious with the things we do in the portfolio. This is when we could potentially be nearing something bad actually breaking. And all these indicators are really flashing red that we are entering the recession, that we are getting potentially closer and closer to the end. Because I'm sure most of you are sick of those, market crash stuff and the world's gonna end and what's gonna happen next. Well, a lot of indicators are telling us again, like the yield curve, like gold going up and oil going down, that we are, beginning to enter the final phase. But no one knows how it's going to end, and no one knows when it's going to end. But we could be potentially, nearing the end. And all those indicators are not showing any positive signs for the economy. But there's one indicator that if it keeps actually going up, it's actually showing that the stock market could have potentially bottomed. And many of you are, can't just take this indicator because a lot of, bearish people watch my channel, but you must be open-minded enough to this scenario. And this is actually gold. And I talked about this many times before, and it's not the most professional chart ever, but the candles are actually the price of gold, and then the other orange line is actually the S&P 500. This is in March 2020. Gold bottomed before the S&P 500, and once gold made a new high, it confirmed that the S&P's bottom was in. The same thing happened in 2009. Gold made a new high. When gold made a new high, it confirmed that the S&P bottom was in. It's not a good indicator to time the bottom, but it's a good indicator to actually, confirm that we actually had a bottom. And this is what many of you keep wondering. But this indicator, again, has been pretty accurate. And the same thing happened in the 2003. Whenever gold recovered and made a new high, it actually marked the bottom in the S&P 500. And this is, again, a question that a lot of people are asking, that is the October low, was this the bottom in the S&P? Because we had a pretty big bounce. We haven't recovered ever since. The longer we get away from this bottom, the harder for us to actually, break it. So was this the bottom or not? I believe gold is going to answer this question for us. And if we look at the 5 years chart of gold, gold hasn't made a new high yet. Gold would make a new high, I believe, if it goes above 2100, if I'm not mistaken. So if gold goes to 2100, in the next week or two, that could tell us that maybe the S&P 500 bottom was actually in. But my personal bias would tell me that the bottom is not in, that actually gold is going to reverse as soon as next week, whenever the Fed surprises us with a 25 basis points hike, which I believe they will do. But something that's very important that actually has happened, and I believe it changed a lot of those things that you think about, a lot of the things that you had in the bearish case, a lot of things that you had in the hard landing case, and I'm one of those people that actually believe we're going to have a hard landing. But a lot of what happened with SVB and how the Fed reacted actually made me question myself. And I believe this is something that every single investor should do. You should always question your thesis. And based how the Fed actually reacted, which very much surprised me, it makes me doubt that we could, have a financial crisis 2.0 and the dominoes are going to fall apart and all that type of stuff. Why? Because the Fed showed us their card. They failed the first test. They show us they have no risk tolerance, no tolerance whatsoever for anything bad happening or anything failing. The administration, the Secretary of Treasury, and the Fed, they want everything to be perfect. They don't want anything pretty much failing. So much that they expanded the balance sheet by, I believe, over $300 billion when they're supposed to be doing quantitative tightening. And this is what the Fed, showed us. So it makes me question myself that if another banks fail, the Fed could potentially do the same. If we have, for example, something like subprime auto loan, a lot of people that could potentially default on their cars, maybe the Fed can also bail them out with the balance sheet while actually keep hiking rates. Or maybe, President Biden can do something like what he did, if you remember, in 2020, whenever we had, the whole thing that you cannot evict a tenant if they're late on a payment. Maybe they could do the same thing with auto loans. So there's a lot of things that they can actually do, and they showed us their cards that they want to do whatever it takes to get reelected in 2024. They don't want anything bad to happen, and the balance sheet is a very powerful tool to make sure that nothing bad actually happens, and the Fed showed us their weakness, that they're going to potentially use it, and they don't want anything bad to happen. So you have to ask yourself, then how are we going to have a hard landing if they can just keep, doing that stuff, bailing people out, while actually keep increasing interest rates, so keep the balance sheet different from rate increases, so they can keep fighting inflation with rate hikes, and they can increase the balance sheet to loan other things money, and they can claim this is just a loan, this is not QE or whatever, and they can maybe kick the can down the road another 5 to 10 years and surprise everyone. This is something that we have to pay attention to. And yes, maybe this will create inflation, but I don't think it will do it in the same exact year. I think it's going to take some time before then we see the effect of the inflation from the expansion of the balance sheet. So you have to be open-minded enough for any scenario. If it's bullish, if it's bearish, if it's the end of the world, or if it's a new bull market, you have to be open-minded enough and trade any type of environment that we could potentially have. Now, we're having many articles which are claiming that the Fed is going to pause the Fed interest rate increases. And I believe this is wishful thinking. I think the Fed will hike 25 basis points, although more people now are expecting it, but not enough people are expecting it. A lot of them are expecting them to pause. And this is why Bitcoin is going up and many of the tech stocks are going up. And I believe the market is setting up for a big surprise that the Fed is going to hike 25 basis points on Wednesday, and this could potentially cause the reversal in gold, and then gold could go back down. This way, we don't confirm that gold made a new high and therefore we had a bottom. I think gold could reverse, as soon as next week, but I could potentially be wrong. But we looked at all those indicators, and now it's time to look at the stock market. And the stock market, again, has shown that it has been pretty resilient, actually, how it went below the 200-day moving average, it went back in the channel, channel, the bear channel, then we bounced back, we went above the 200 days, then we went below the 200-day. Well, this is good, but it's because it actually shows us that the 200-day has pretty much no support. But I would prefer the S&P to go back in the bear channel and actually stay in the bear channel. If it just goes back here and it stays in the bear channel, this would be a much easier market to actually, make some returns in and do many other things. And I believe we're gonna see that maybe next week, whenever the Fed actually, shows that they are gonna keep fighting inflation, that they're not gonna pause, and they're gonna talk about that this expansion of the balance sheet was just a loan that they're gonna pay back, and then they're gonna do it again in the future, which again should make you question any thesis you have. And it's very, very confusing of where we are in the S&P 500, which is why I believe, and it's been true actually, that since the start of the bear market, the market hasn't rewarded bears and it hasn't rewarded bullish people. It has rewarded people that actually have the open-minded enough to actually be bullish or be bearish whenever you have to. If you're more of a very long-term investor, then you could accumulate positions and dollar cost average down. But if you do more tactical trades like I personally do, I was shorting the S&P whenever we hit the bear channel on the top. And I was buying a lot of stocks whenever we were going down. In fact, around June, I actually bought ARK Innovation. Why did I buy ARK Innovation? Because I saw, it was priced in on a lot of fears and stuff. I saw a big reversal coming, so I bought ARK Innovation. I made 20% in, was it 4 or 5 weeks? And a lot of the people in my group, they almost quit. Like, how can you buy ARK Innovation? Well, because you have to be open-minded enough. If you're trying to make money in a bear market, you have to be bullish, you have to be bearish, you have to take all those scenarios. But if you're a very long-term investor, which I do have long-term positions that I never sell, then you could just dollar cost average in them, and this is what I've been doing whenever they get cheap enough. I dollar cost average in, and then I have my tactical trades, which I do in long positions, short positions, and I don't care about narratives or if I want the world to end. We all, I think, want the market to crash so we can buy things for cheap and then hold forever. We all want this to happen, but we have to be open-minded enough that if this actually doesn't happen, what are you going to do about it? And this is where a plan comes in, where you could make a plan. If the market goes down, what should I do? If it goes up, what can I buy or what should I do? Instead of watching who's gonna fail next and if Bank of America is gonna go down or Credit Suisse or whatever, which is something you could pretty much not make any money on. So this was my video for today. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.